In today's video, I am going to be breaking down ZWK, which is a very interesting ETF right now, especially for what's going on in the entire world. Let's get down and let's check it out. So while this is an ETF I have broken down before, it's actually a very good time to kind of reevaluate if it's a good choice to buy right now. ZWK is a covered call ETF, which basically means that they hold shares that they sell calls against. And basically what that means is they can get a higher yield to pay out to us investors. It covers the US banking system, and that means that, of course, the question does come up, is it really a safe investment? Because, of course, American banks are not generally as safe as Canadian banks for us Canadians to invest in, but that yield does look very, very interesting, to say the very least. Now, I'm going to tell you right now, this is actually a 6.5% dividend, just because Yahoo goes over the past year and they recently lowered their dividend. Now, keep in mind, they were not lowering the dividend because the banks were lowering their dividend, because the banks didn't. In fact, they actually raised their dividend substantially. The reason being is, of course, the yield when it comes to, or the premiums when it comes to the options. Generally speaking, right now, the premiums are not selling to or for what they used to sell for, and because of that, the price of the yield has come down on this ETF and pretty much every other covered call ETF. So that is not a big source of concern. It's basically you're investing in these banks to get the dividend, but also the fact that these guys are running covered calls against it, which is generally something that us regular retail investors don't have the time to do. The MER is 0.7%, which is quite high for an ETF, but when it comes to covered call ETFs, it's generally in line. There's a lot of manual labor that comes into doing covered calls, and that's why that is much higher than some other regular ETFs. The average volume is quite high at 47,000 shares traded every single day as well. Now, this is not a very old ETF. This was brought in 2019, and then, of course, the virus did hit this like everything else. It has had a big run up, and then recently there's been a little bit of a drop off, which is kind of concerning to a lot of investors. I keep on getting quite a few comments on this channel about that. Now, if we do look at the historical dividend, it's gone from 18 cents a month down to 17 cents a month. Again, that's because of the premiums when it comes to, of course, the options they are selling. The top holdings are Goldman Sachs, First Republic Bank, Bank of America, which is one that I used to directly invest in, as well as Signature Bank and Ameriprise, Wells Fargo, which is a company that many people dislike, and SVB, PNC, US Bancorp, and JP Morgan, of course, being one of the top 10. The top 10 holdings does equal about 55% of the total assets as well. Now, what does this really mean? And of course, when it comes to the American banks, are they really susceptible to another crash? Well, guess what? Most of the time, most stock market crashes happen across every sector, most of the time. So when that happens, that's just one of those things that is usually a good buying opportunity if nothing's changed with that underlying business. For example, the virus that we just went through, nothing happened when it came to the banks for their underlying business. They were still making an ungodly amount of money from the fees that they charge for their bank accounts, and every bank has been able to now make a massive income doing that, but also credit card fees, but even more, like they're offering more mutual funds, ETFs, and when you start really looking at it, when you start looking at the fact that every time the American or the Canadian government prints money, guess what? That money has to go somewhere. Where does that money go? Well, that money generally goes to people's bank accounts, and then it gets stuck in the banks, which means the banks make more money. Why is that? Because, of course, when, let's say, I get a dollar printed from the government, a brand new minted dollar bill that never existed before, I get that dollar bill, I put it in my bank, the bank can now loan that dollar bill out 10 times over. And if I'm keeping it in my checking account, that means that they basically got that money for free, and I'm probably paying for them to hold on to it. so that now they can rent out that dollar for 10 times over, which means that they're making, let's say, a 5% interest on that money times 10. They're actually making probably around 50% of what I put in every single year. This is how banks make a ton of money when there's a ton of money printing. And if I'm spending that dollar, let's say to Walmart as an example, Walmart needs to keep their money somewhere as well. They don't just put it underneath their beds. So that money, again, goes back into the banks. Either way, the banks will always win when there's money printing. It doesn't matter what currency it happens in. The banks will always win. This is why I am so strong about so big about the banks right now, is because there's so much money printing that these banks, sure, there's inflation, but that's not affecting them because they're renting out their money. They're not holding on to it underneath their beds. They're renting it out so that they can make it back 10 times over. So this is why inflation doesn't really necessarily hit the banks, and it actually helps the banks in most cases. Because when inflation happens, there's interest rate rises, which means that they can charge more money for that 10 times over that they're renting out. This is why the banks, when there's money printing, is probably one of the best investments that you can make, in my personal opinion. Now, Goldman Sachs is the number one holding in this ETF. It pays a 2.5% dividend. Average volume is 3 million shares traded every single day, so it's a pretty solid bank. It's had the big run like every other bank. The only scary thing is it's got this nice looping top to it, which generally means whenever there's a hump like this, it's got some more downwards pressure potentially, so something to keep an eye on. Over the past 5 years, again, we still see that hump on that stock price, and that's still something that is kind of concerning in my opinion, at least for Goldman Sachs. And they did just recently raise their dividend ridiculously. It went from $1.25 a share to $2 a share, which is like massive. That's literally over a 50% increase. And remember what I said about earnings? Yeah, guess what? Yeah, that's happening there. Look at that growth. Look at that growth in revenue, in earnings. Massive. First Republic Bank is another one that is quite interesting. This has got a smaller dividend. However, volume is up there as well. When we look at the chart, it doesn't have that massive looping. It has a little bit of a fall there. So this could be a good buying opportunity potentially. Again, it's something to really watch. It did not raise its dividend as much as Goldman Sachs and some other banks. It really only raised its dividend by 10%. However, again, you're going to see massive growth when it comes to revenue and earnings. They've also had 4 beats in a row as well. And then when it comes to Bank of America, which is a bank that generally makes a ton of money when it comes to interest rates rising, they pay a 2% dividend. Massive volume. I've played this as a long-term purchase. I've played this in the options markets in the past. This is one of those companies that because of the volume, you can play it many different ways. This one also doesn't have that loop like Goldman Sachs, which is kind of good. It has, however, broken through its recent trend, so something to watch, however, at the same time. They did raise their dividend too, but again, it wasn't as massive as Goldman Sachs. They haven't had this massive growth in revenue just as of yet, but we will probably see that once interest rates start rising once again. So these are 3 very good businesses and a very interesting ETF. Right now, I think that it would be a fantastic time to get into something like this. I personally do own ZWK as an ETF, and I have a very large portion of my portfolio invested into it, so keep that in mind. Always remember to do your own research and never trust a random person online. Always try and figure out their ulterior motive. I don't have one. I'm telling you my own personal thoughts as to why I personally invest in this ETF, and I want you to make your own thoughts as to why you should invest into it as well, or why you should not invest in it. Always make your own decisions. Never trust anybody anywhere. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.